So before I talk about how I think we're ending too big to fail in the U.S. and some thoughts about how that strategy might have some lessons here in Europe, let me just review a little bit why too big to fail is wrong. Because you know, sometimes I think we have to keep reminding ourselves why we want to get rid of it, because you're not going to be able to structure a resolution mechanism that is going to end it. You need to have clarity of thought about why you want to end it. And first of all, as I've already alluded to, it's unfair. It promotes political instability. It creates most people don't get bailouts. I don't, if I buy a house at the top of the market and my mortgage goes underwater, nobody's going to bail me out. If I make a stupid investment and lose money, nobody's going to bail me out. So why should these very large financial institutions, whose managers get a lot of big bonuses and salaries, why should they get this special preference? So it makes people angry, and rightfully so. And it's dramatically inconsistent with a market-based democratic system. So I guess that is our sense of justice and fair play is important here in reminding ourselves why we want to end this pernicious doctrine. But even setting aside the morality and the emotion of it, which is justified and understandable, it's just bad economics, because it makes your financial sector too big, and it encourages financial institutions to be bigger, right? The heads they win, tails we lose kind of mentality, so they can go out there and take as many risks as they want and juice up their profits with a lot of leverage, and if there's a problem, boom, they got to put on the government. That just encourages them to take risk, and that encourages creditors, shareholders and bond investors to skew investment dollars to them, because they feel, they're protected. They've got to put on the government. And so the other parts of the economy, like manufacturing, energy, infrastructure, they don't get those kinds of government benefits, but you're skewing resource allocation to the sector. You're making it bigger. When we need a financial sector that's smaller, not bigger. I think that's pretty much true globally. It hurts innovation because it disadvantages the smaller competitors. So the big banks have advantages with their funding cost. It makes the smaller banks less competitive, creates a barrier to entry. Again, that's if you want a dynamic system, you don't want to give very large institutions this advantage over smaller competitors. And finally, it interferes with the market's natural corrective mechanism. And this is something we didn't do as well as we should have in the U.S. on this score, because I think one thing we did do that was not done in Europe, which should have been and can still be done in Europe, we did force our banks to raise a lot more capital through the stress testing process. But we did bail most of them out, let's face it, and we propped them up, and we didn't force them to clean up their balance sheets. So yes, we made them get in more capital, but we gave them many, many years to nurse their balance sheets and try to clean those up. And so we did interfere with the market's natural corrective mechanism, and this was not a good thing for our economy, because sick banks don't do a lot of new lending, right? Sick banks, they nurse their balance sheet, they play it safe, they'll take their cheap deposits and reinvest it, in government securities, or in our country, GSE securities, make a little bit of, risk-free spread, and they'll do that. They'll nurse themselves along until they get back into health, and they're not going to go out and make small business loans or anything else that's got, a scintilla of risk to it. They're going to try to play it pretty safe. Also, you don't want to reward bad management. You don't want to reward stupid business models or unsustainable business models. And again, if you prop bad managers up, if you prop unviable business models up, you keep them going. And again, you interfere with that natural corrective mechanism to let those institutions fail, reallocate those resources to managers that are doing a better job and business models that are doing a better job of serving real economic needs. So I do think this was a mistake that we made in 2009. We really kept doing the bailouts. We pretty much said everybody over $100 billion is too big to fail. We're not going to let them go down. And yes, of course, that did stabilize our financial system. But I think it did impede this natural corrective mechanism. And I think if we had been a little more punitive and forced them to take losses, get their balance sheet cleaned up, I think we would have had a stronger economic recovery, because as it is now, we're still pretty sluggish, as you know.